look at everything with a 5-year investment time horizon. We do have a forecast for truly disruptive innovation in 2030. And we think, obviously, crypto is a big part of that. We believe today that all innovation, I think blockchain technology is going to be involved with most of the platforms we have centered our research on. So the genomic platform, genomic sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. We think there are going to be all kinds of convergences taking place. And we're going to go from $10 trillion in market cap in the public markets attributed to innovation, disruptive innovation, to $210 trillion by 2030. And we think blockchain technology is truly a revolution. We do believe that Bitcoin will usurp 50% of gold's role. This is digital gold. So that's roughly a $5 trillion opportunity right there. So the smallest one is remittances. We think that it will take most of the remittance market. The remittance market is a $600 billion market. We have insurance policies, high net worth individuals watching, confiscation of wealth. And with all the turmoil in emerging markets and elsewhere, the Middle East, who knew that MBS was going to take his cousin's wealth away? So don't they wish they had some Bitcoin and private keys? Also, companies allocating some of their cash or diversifying some of their cash into Bitcoin. We've seen Tesla do that, Coinbase, Square, of course, MicroStrategy. You're going to see some countries putting Bitcoin into their treasury. We assume only 1%. But if you look at the building blocks, and then finally institutional, how much will institutional investors account for this? Well, we assume that institutional investors will put 2.5% of their allocation to Bitcoin. And that isn't even as big as the global digital gold opportunity. I think it is an anti-fragile asset, and every one of these crises strengthens it. The network becomes stronger and healthier. The price is extremely volatile, as is the case with most innovations and new technologies in their early days. We think that the entire ecosystem is going to appreciate from $1 trillion today to $25 trillion by 2030. Last year was a terrible year for crypto. Why was it such a bad year? The first reason was algorithmic stable coins. We didn't believe in those at all. They weren't rules-based, and so that was the Terra Luna fiasco. So you have to do your research in this space and not try to ride a dream of some sorts. But then if you look at Celsius, 3AC, FTX, all of them went bankrupt. Why? They were centralized and opaque, not transparent at all. In fact, Sam Bankman-Fried, so SBF, as everyone came to know him, he didn't even like Bitcoin. Why not? Bitcoin is totally decentralized, completely transparent, and auditable. He couldn't control it. And of course, he thought he was a master of the universe. So Bitcoin actually, and Ether, neither Bitcoin nor Ethereum, those two networks, skipped a beat throughout all of those controversies. All of the transactions cleared, all of the margin calls that were a part of smart contract, they were satisfied. So actually those crises proved the concept. Now we come to the banking crisis this year. Just think about what a proof of concept this is. Decentralized, transparent, audible networks didn't skip a beat. And here we had, stocks halted in the stock market, in the regional banking space, because there were bank runs taking place. That, of course, was not happening on these decentralized networks. And so I think that, as you say, digital gold has now gained even more credibility. It came out of the last crisis, the 08-09 crisis is when Bitcoin emerged, and it took another crisis for others to understand, oh, wow, maybe our banking system isn't as safe as I thought it was, and maybe I need a hedge against that. Bitcoin is a very good hedge. It's a great insurance policy. I think it is an anti-fragile asset, and every one of these crises strengthens it. The network becomes stronger and healthier, and we have metrics to manage that. The price is extremely volatile, as is the case with most innovations and new technologies in their early days. There's a lot of uncertainty. Why? And this is a perfect example. There's the old guard, and they're trying to say, we're going to wipe this innovation off the face of the earth. It has no reason to exist. And the innovation just gets stronger and stronger and stronger with time. And if you look at the measurements of the health of the network, the Bitcoin network, the Ethereum network, their health has actually improved all of this turmoil. That's essentially what I would say. And, we think that crypto is 3 revolutions in one. One is the money revolution, which is what we're talking about here when we talk about Bitcoin. And that could be the biggest of the revolutions. The first global private, no government interference, a digital rules-based monetary policy with no central point of failure. Who knew Silicon Valley Bank was going to be a central point of failure? Nobody. It's shocking. But I will tell you, just in terms of setting this up a bit, the second revolution, let me do this first. The second revolution is a financial services revolution, and that's called DeFi. Many people call it DeFi. Ethereum is the network most used for this. Chris Berniski, who was our first analyst, would like to name it the Internet Financial Services Revolution. That way, more people will understand it. DeFi sounds gimmicky, and I agree that might be so. But we do think that it's going to revolutionize financial services and collapse the cost. And then the third revolution, Web3, metaverse, is effectively, for the first time, digital property rights. That's a big idea too. So we think that crypto, the entire ecosystem, is going to appreciate from $1 trillion today, and Bitcoin's just a little less than half of that, to $25 trillion by 2030. These are very big ideas. Now, to get to the economics part of this, the reason we're going through this crisis is 2 serious mistaken assumptions that banks and examiners have made, and also that the Fed has made. The first is that interest rates, after we went through COVID, and we were worrying about a depression, banks said they were flooded with cash from the stimulus programs. And so banks put it to work in long-term interest rates, which at the time were only really 1.5%, because they thought the economy was going to be shut down for a very long time. And the Fed told them that it thought that the economy was going to be down and out for quite a while. So they put money into securities at 1.5%, and never dreaming that the Fed would raise interest rates by 19-fold in 1 year. Well, that happened. That has never happened in history. In fact, the biggest increase that we have seen in a short period of time was 2-fold back in the early 80s under Fed Chairman Volcker when he was trying to strangle inflation. But 19-fold, this is, a magnitude earthquake we have never seen. The economic measures that the Fed is basing its policies on are old. They're based in the industrial age, and they get revised in major ways as technology begins to inform them that, wait a minute, we're not measuring this correctly. And so we think they've been relying on lagging indicators.